Take a look at the market reaction to the president's comments. Tech and semiconductors seeing particular strength as the China trade deal remains intact for now, but the possibility that things could change is weighing on one top strategist and fast money friend, JPMorgan's Marko Kolanovic, dialing down his positive outlook for stocks, saying, quote, a breakdown of supply chains and international trade between the U.S. and China would justify equities trading drastically lower. So did the president put those worries to bed today, or could trade reemerge as a big market threat this summer? And more broadly than trade, just this sort of ramping tensions between the U.S. and China, which could result in, domestic Chinese consumers, for instance, not buying American products, Tim?
Yeah, and I think, first of all, you have to give Marko a lot of credit. JP Morgan's team has had a very, I think, sensible call here where they've looked at market factors, they've looked at ownership, they've looked at momentum, but they've also then started to look at fundamentals. And so, Marko and team saying, hey, not as buoyant of a return to work in terms of the economy is something I think we should be listening to. Having said that, the word of the day yesterday was bluster, look, on China trade policy, bluster is certainly the need on both sides. Remember, there's a lot of posturing and jawboning on both sides. But ultimately, who's really in a position to dig their heels in right now? And again, we'll kind of weigh the short term to the medium term, who can be a longer term player here. When it comes to stocks, and look how we reacted in the last hour and 10 minutes of trading. And look at some of these Chinese ADR names. Alibaba from 254 to the close was up just over 4%. Somewhere around 198 to 207 on the close. So we saw that with Tencent. We saw that with emerging markets. We saw that with semis. I think if you look at semiconductors, they're the best roadmap to follow for what we had last year. And remember what kept going higher? Semis were going higher even in the face of this. I think right now we can continue to see that type of movement.
The other part of Marko's call in terms of dialing down the optimism is that he believes that there has been politicization of the COVID-19 issue, and that perhaps that could impact consumer behaviors and that could influence the timeline for reopening the economy. And if only half the economy reopens, that's not enough to get him to the forecast of all-time highs in 2021. Steve Grasso, I'm curious what you think of today's action. It did seem like the markets traded as if there was pretty much an all clear when it comes to the worst-case scenario regarding China.
Yeah, I think that the markets are trading on, well, two things. Today was the MSCI rebalance day, so that influenced a lot of the flows. But when you look at China, I think a lot of that is secondary. Let's just look at what the market's pricing in. The market's pricing in a pandemic, so they're not worried about China just yet. It might affect the headlines from minute to minute, but ultimately we're worried about the pandemic. And the one word that's going to save all this in shareholders is the Fed. If the Fed is still there, central banks are still there, we're going to look past China for the meantime. We already looked at China trade. So China trade was the major headwind for this market, for the economy. We heard all that before. The market shrugged it off. So what is the market going to do now with the same sort of ratcheting up? As long as you keep the trade deal intact, I think that the market will continue to grind higher, and it's myopic on the pandemic. So once these economies start to reopen, if we don't get hiccups, it's a big if, but today, this is the first day I'm back since March, and if we start to see reopenings of economies and we don't see major spikes higher in cases or in deaths, the market will grind higher because the Fed is still there.
Karen, market thoughts?
Yeah, I kind of agree with both Tim and Steve. I think that Trump was trying to thread a needle today, which was to blame China very directly for COVID coming to the United States so that they're responsible. He's not responsible. Re-elect him. That was part of the message. The other part of the message is I'm going to talk very tough on China, which he did, but I'm actually not going to do anything because I don't want to rock the boat for this recovery or for the markets. So I think that was what he was looking to do. I think he was somewhat successful, certainly in the second and third part of that. So I agree with Steve. It's the Fed, and it's how are things going to open?
We heard, Guy, during the negotiation of the Phase 1 trade deal, of all sorts of other little ways that China retaliated short of official actions, slowing down of shipments, at ports, for instance, to sort of gum up the supply chain. I mean, things like that can still happen even without any sort of official retaliatory action from Beijing.
No question about it. And look, a lot of this takes place with no return of serve from the Chinese. I mean, you're going to see a return of serve. I mean, I'm hard-pressed to believe this rhetoric's not going to get ratcheted up. I think everybody makes fair points. I think President Trump successfully, at least in the eyes of the market, thread a needle. A lot of that had to do with the fact that it's probably month end, time of the day, all those things. But, you know, that was a pretty hawkish statement if you really listen to it. And I'm hard-pressed to believe there's not going to be some return of serve by the Chinese next week. So although I do think the Fed controls much of this, I think this heightened rhetoric between the U.S. and the Chinese can't be underestimated in terms of what it means to the market. So label me probably somewhat skeptical still.
Sunday night should be a very interesting night, Tim.
Yeah, I think we'll get more politics and more grandstanding, but I also would just fall back on, return of serve is fine. I think both sides need to kind of dig in their heels on the baseline, and we're going to see a long rally of this. This isn't going to end overnight. So I think both politicians will do what they need to do. Meanwhile, stimulus on both sides of the world is going to continue. So markets are more focused on that. Think of where we were with the trade war, even at the low points. And when the Fed stepped in, the trade war meant nothing. And for better or worse, we're not happy about the Fed. We're not happy about nationalizing assets in our credit markets. I don't think we are. I'm not. But I think this is the market dynamic that we have right now.
Here's the question. I mean, here's the other question. Aside from formal actions from Beijing, formal retaliations, that, we have U.S. companies going into deepening their presence in China, relying on China for growth. Did you see the move in Beyond Meat today? It was up 5+% on news that it was, forming a relationship with KFC and Yum in China. It was up 6%. Thank you, Engel, control room here for firing up this graphic. We just, did the story recently about Popeyes going into Shanghai and the huge lines. I mean, U.S. companies are depending on China for growth. So can that continue in parallel with ramped up U.S.-China relations, Karen?
I think on the one hand it can. I think that Chinese consumers are going to want, the Popeyes of the world. But on the other hand, the trade war last time was a very big message for companies that they need to have alternatives in their supply chain to China. And so that wasn't fully implemented. And I think there are still companies that, need to have alternative supply chains. So they're doing that. I don't know which of those two factors is bigger, though.